Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Zulaika binti Muhammad Syamil and my magic number 1230735. We are from Group 3 and here I'm introducing our team members which are Kisha, Asha, Dania, Amni, Liana Atira, Irina Safia, Marha and also me from this group. Today I will be presenting the introduction to our study on the comparison between Sukuk and conventional bonds. Capital markets play an important role in supporting economic growth by helping governments and corporations raise funds from investors. One of the most common financing instruments is the conventional bond, which provide investors with fixed interest payments and repayment of the principal amount at maturity. However, in Islam, earning or paying interest known as riba is prohibited. To address this issue, Sukuk were developed as a Sharia-compliant alternative. Unlike conventional bonds, Sukuk represent ownership in tangible assets or investment projects, and investors earn returns through permissible sources such as rental income or profit sharing instead of interest. This topic is particularly important because Malaysia is recognized as one of the world's leading centres for Islamic finance and Sukuk issuance. The Malaysian capital market operates under a dual financial system where both Islamic conventional financial instruments are available. The market is regulated by the Securities Commission Malaysia, Bank Negara Malaysia and Bursa Malaysia, which ensuring transparency and compliance with financial regulations. Recent studies have also shown that Sukuk may offer attractive investment benefits. For example, research suggests that Sukuk can provide higher returns, lower investment risk, and better portfolio diversification compared to conventional bonds. These findings make it important for investors and policymakers to understand the differences between the two instruments. The objective of this study are to compare the structural differences between Sukuk and conventional bonds, analyze their risk and return profiles, and evaluate their market trends and investment potential in the both Malaysian and global capital markets. In terms of scope, this study mainly focuses on the Malaysian capital market, with supporting information from the global market. It reviews literature published from 2020 onwards and compares three major Sukuk structures, which are Ijarah, Musyarakah, and Mudarabah, with fixed rate and floating rate conventional bonds. The analysis is conducted within the regulatory framework established by the Securities Commission Malaysia, Bank Negara Malaysia, and also Bursa Malaysia.
For this part, I'll be presenting the overview of Sukuk, covering what it is, how it's structured, the main types, and Malaysia's position in this market. Let's start with the definition. The word Sukuk comes from the Arabic word sak, which means a deed or certificate. Essentially, Sukuk are Sharia-compliant financial certificate that represent undivided ownership in a real asset, project, or business venture. I want to highlight one common misconception here. Sukuk is often casually called Islamic bond, but that's actually not quite accurate. Unlike conventional bond, Sukuk doesn't represent a debt obligation. Instead, Sukuk holders own a proportionate share in actual asset or enterprise, and their returns come from profit, rental income, or sale proceeds, not from interest, because interest or riba is prohibited in Islamic finance. For Sukuk to be valid, it must always be backed by a real underlying asset or business entity. Now, how is Sukuk structured? Typically, a special purpose vehicle or SPV is set up to hold the underlying asset on behalf of the investor. This SPF issue the Sukuk certificate and manage the distribution of return back to the Sukuk holder. Because of this structure, Sukuk holders share in the actual risk and reward of the underlying asset rather than just holding a pure creditor claim. Fun fact, the world's first Sukuk was actually issued right here in Malaysia by Shell MDS back in 1990. Let's go through the main type of Sukuk. First, Sukuk Ijarah, which is based on leasing agreement. Investors receive rental payment as their return, and this is actually the most commonly used structure. Second, Sukuk Murabaha, a cost plus profit sale contract where the asset is sold at the markup price paid in installment. Third, Sukuk Musyarakah, which is a partnership structure where both parties contribute capital and share profit and losses based on pre-agreed ratio. Fourth, Sukuk Mudarabah, where one party provide the capital and the other provide expertise. And lastly, Sukuk Wakalah, an agency based structure where investor appoint an agent to invest their fund into Sharia compliant asset on their behalf. Finally, let's talk about Malaysia's position in the global sukuk market. Malaysia is not just a pioneer, we are the global leader, holding the largest sukuk market share as of June 2022 and also having the highest number of Islamic funds globally as of 2021. This is backed by strong regulatory framework from the Security Commission Malaysia and Bank Negara Malaysia, which have established clear Sharia governance standard over the year. As you can see, Sukuk has grown to become a very dominant force in Malaysia capital market, and to understand just how dominant, let's compare it against the conventional bond market. Now let's move to the conventional bonds, the more traditional, debt-based counterpart to Sukuk. Starting with the definition, a conventional bond is simply a debt instrument issued by a government or corporation to raise funds from investors. When an issuer sells a bond, they are essentially borrowing a principal amount, also called the face value, from the bondholder. In return, the issuer promises to repay the amount on a fixed maturity date, while also paying a paid-in interest known as the coupon through the bond's tenure. Unlike Sukuk, bondholders are creditor, not owner, so it's purely a contractual debtor-creditor relationship with no element of asset ownership at all. Next, let's look at how bonds actually function in the market. There are two main segments. First, the primary market, where new bonds are issued directly to investors through the underwriter and prospectus. And the secondary market is where existing bonds can be traded before they mature, either on Bursa Malaysia or over the counter through appointed banks. One key concept here is the bond price and yield move inversely. So when interest rate in the market go up, the price of existing bond actually goes down, and vice versa. In Malaysia, specifically, a government security like MGS and GII are issued through competitive auction managed by Bank Negara Malaysia. Moving on to the key characteristic of bond can have either a fixed or floating coupon rate. Their maturity period can range from short-term commercial paper to long-term government bonds of up to 10 to 30 years. Credit rating assigned by agencies like RAM and MARC play a big role too, because they reflect the issuer default risk and directly influence the yield investor demand. Bond can also be secure, meaning backed by collateral, or unsecure, which we call debentures. And lastly, some bonds are callable, meaning the issuer can redeem them early, typically when interest rates fall. Finally, on type and market position. In Malaysia, government bonds include MGS, GII, and Treasury bill, while corporate bonds are typically issued as long-term bonds, medium-term notes, or commercial paper. Interestingly, new issuance of Malaysian corporate bonds actually declined by almost 20% in 2023, falling to 118.3 billion. And this connects back to what I shared earlier about Sukuk. Corporate Sukuk now make up about 78% of total corporate bond and Sukuk issuance, which clearly show that conventional bonds are gradually losing market share to Sharia-compliant alternative.
Now, I will be presenting about the structural differences between Sukuk and conventional bond. First of all, in terms of ownership, Sukuk represents partial ownership in an underlying asset, project, or investment activities. Investors are the co-owners or the beneficiary. Meanwhile, conventional bond represents a credit-debtor relationship. Investors hold a financial claim but not the ownership of the asset. Additionally, returns mechanisms for Sukuk are generated from asset performance, rental income, or profit sharing. For example, Sukuk al-Ijarah and Sukuk al-Mudarabah, different with the conventional bond, which are fixed or floating interest payment independent of asset or project performance. Furthermore, risk allocation for Sukuk emphasizes risk sharing. Investor bear ownership risk, including asset performance and market fluctuation. On the other hand, risk burden for conventional bond lies with the issuer, who must repay the principal and interest regardless of the project success. Also, Sukuk and conventional bond are exercising different kind of activities when it comes to compliance. Sukuk requires dual compliance, which are financial regulations and the Sharia governance. Structures must avoid riba or interest, gharar or uncertainty, and maisir or speculation. On the other hand, conventional bond governed by secular financial regulations and corporate law. No requirement for Sharia compliance. Besides that, ethical dimension for Sukuk and conventional bond are also different. Sukuk promotes ethical accountability, ensuring investments are tied to real economic activity and Sharia principle. Meanwhile, conventional bond focus on contractual obligation and repayment terms, with no ethical screening requirements. Last but not least, investors' expectation when it comes to returns for Sukuk may vary depending on the asset performance. Sukuk introducing variability while aligning with Islamic finance principle. Conversely, returns for conventional bond are predictable due to fixed interest payment, which are appealing to risk-averse investors.
Next, I will discuss the three main risks associated with Sukuk investment, namely credit risk, liquidity risk, and interest rate risk. First, credit risk. Credit risk refers to the possibility that the issuer of special purpose vehicle may fail to fulfill its payment obligations to investor. Unlike conventional bonds, Sukuk are asset-backed instruments, which means investor may need to claim rights over the underlying assets in the event of default. The level of protection depends on the financial strength of the issuer, the quality of the underlying assets, and how well the Sukuk structure can be legally enforced. Therefore, assessing Sukuk credit quality can be more complex compared to conventional bonds. Next, liquidity risk. Liquidity risk is one of the common challenges in the Sukuk market. The secondary market for Sukuk is relatively less developed compared to conventional bonds because most investors, especially Islamic financial institutions, tend to hold Sukuk until maturity rather than actively trade them. As a result, there is less trading activity, making it harder for investors to sell their Sukuk before maturity. In addition, different Sukuk structures reduce market liquidity. Finally, interest rate risk. Although Sukuk are Sharia-compliant instruments, their market value is still influenced by changes in prevailing interest rate. When market interest rate increase, the price of existing Sukuk generally decrease because investors demand higher return from newly issued instruments. This risk is more significant for long-term Sukuk. Furthermore, many Sukuk use benchmark rates such as London Interbank Offer Rates or Secure Overnight Financing Rate, making their returns indirectly affected by changes in conventional market rates. In conclusion, investors should carefully evaluate credit risk, liquidity risk, and interest rate risk before investing in Sukuk, as these are the most significant factors that can affect investment performance and returns. So that's all from me. Thank you.
Next, I will explain the risks associated with conventional bonds. Conventional bonds are exposed to several risks that may affect investor returns and the value of their investment. The first risk is liquidity risk. Liquidity risks occur when investors face difficulty selling their bonds in the secondary market without accepting a lower price. During periods of financial stress, low market liquidity can increase uncertainty and force investors to sell their bonds at a loss. According to Aurora and Mehra 2023, illiquidity is one of the major challenges in the corporate bond market because it negatively affects bond valuation and trading activities. The second risk is default risk. This refers to the possibility that the bond issuer may fail to make interest payments or repay the principal amount when the bond matures. This risk is especially relevant for companies with weak financial performance or high debt levels. In case of financial distress or bankruptcy, investors may not recover their full investment. Therefore, investors usually evaluate the issuer credit rating before investing, as bonds with lower credit rating generally offer higher yield to compensate for the higher risk. The third risk is interest rate risk. bond prices and market interest rate have an inverse relationship. When interest rate rise, existing bond price tend to fall because newly issued bonds offer higher return. As a result, investors who sell their bond before maturity may experience a capital loss. Chen et al. 2023 also found that bond risk premiums are closely linked to liquidity risk and default risk, particularly for lower rate bonds. In conclusion, investors should carefully assess the issuer financial strength, creditworthiness, market conditions, and also economic environment before investing in conventional bonds. Understanding liquidity risk, default risk, and interest rate risk is important for making informed investment decisions and minimizing potential loss.
So next we move to regulatory and Sharia framework. First, different underlying principles. Sukuk and conventional bonds differ in their fundamental principle. Sukuk is structured based on Islamic finance principle and must avoid riba, gharar and maisir. This means Sukuk cannot generate return through interest, but in contrast, conventional bonds are debt-based instrument where investors earn fixed return through interest payment. Second, Sharia governance. According to Gazelle et al. 2022, Sukuk requires additional Sharia governance to ensure that its structure and transaction comply with Islamic law. This involves supervision by Sharia and authorities such as the Sharia Advisory Council and the Security Commission in Malaysia. However, according to Rahman et al. 2022, conventional bonds do not require Sharia supervision because they are only regulated by capital markets law. Third, asset ownership. One important difference is asset ownership. Sukuk holders have beneficial ownership is underlying asset, meaning their investment is linked to real asset and business activities. On the other hand, bondholders do not own any asset. They only have a contractual right to receive repayment from the issuer. Last but not least, higher compliance costs and complexity. Issuing cost is more complex and costly than issuing conventional bonds. This is because Sukuk requires extra processes such as Sharia review, legal structuring, documentation, and regulatory approval. Although this increases compliance costs, it improves transparency, governance, and investor confidence.
Next, let's start with how each instrument works. A conventional bond is debt-based. The investor lend money to a company or government and in return receive fixed interest payment plus the principal back at maturity. Meanwhile, Sukuk is different. Instead of lending money, the investor buy ownership right in an underlying asset. A special purpose vehicle (SPV) manage the assets and pay the investor rental income or a profit share with no interest involved. This keeps it Sharia compliance. Now looking at return, the yield behave differently depending on maturity. For government issues, Sukuk yield are slightly higher than conventional bond due to specific Islamic demand. For a short-term corporate instrument, Sukuk actually offer lower yield because strong demand from Islamic investor compress it. But for long-term corporate instrument, Sukuk carries a higher yield premium that investors want to be compensated for the uncertainty of a longer period. The key takeaway here is that the lender versus partial owner structure create fundamentally different yield curve. Now it's about risk level and investor profile. Both instruments share common risks which are market, credit, liquidity, operational, legal and regulatory. But Sukuk carries two additional risks. First, Sharia compliance risk. If the instrument is found to violate Islamic law, investor confidence and asset value can drop. Secondly, secondary market risk, which is Sukuk, has a more limited secondary market, which means liquidity can be a concern and payment delay are possible. Now, who is each instrument for? Conventional bond suits what we call the active profit maximizer, which is someone who need a large liquid secondary market for frequent trading or prioritize financial return above everything else. Meanwhile, Sukuk suits the values-driven long-term holder, which is someone who prioritize halal assets, value stable and predictable rental income, and is comfortable holding until maturity without needing to sell quickly. One important finding here is that Sukuk adoption is not driven by demographic like age, gender or education. What actually matters is financial education and awareness. That is the real bridge between Muslim and non-Muslim investors. Sukuk and conventional bond serve similar financing purpose but operate on different structure, risk profile and investor motivation. Understanding this difference is important not just for Sharia compliance but for making smarter investment decisions overall. So that's all and we move to the next presenter.
Now, I will present the final section of our report, which focus on the market trends, conclusion, and recommendations. Firstly, let's look at the Sukuk market. Globally, the Sukuk market has continued to grow steadily. According to the Islamic Financial Services Board, global Islamic financial assets reached approximately USD 3.88 trillion in 2024. This growth is mainly driven by increasing demand for Sharia-compliant investment, infrastructure financing, and sustainable financial products such as green sukuk. In Malaysia, the Sukuk market continues to perform strongly. Malaysia remains one of the world's leading Islamic capital markets due to strong regulatory support from Bank Negara Malaysia, the Securities Commission Malaysia, and Bursa Malaysia. According to the Securities Commission Malaysia, the Malaysian capital market reached 4.2 trillion ringgit in 2024, reflecting the resilience and continued growth of both the Sukuk and bond markets. Next, let's look at the conventional bond market. Conventional bonds remain one of the largest fixed income markets in the world. Governments and corporations continue issuing bonds to raise long-term financing. Although rising interest rates have reduced existing bond prices, conventional bonds remain attractive because they offer stable returns, predictable income, and high liquidity. Several factors also influence the development of both Sukuk and conventional bond markets. These include economic growth, monetary policy, investor demand, supportive government regulations, and financial innovation. Together, these factors strengthen market development and increase investors' confidence. In conclusion, although Sukuk and conventional bonds serve similar financing purposes, they differ significantly in their structures and principles. Sukuk represents ownership of underlying asset and complies with Sharia principles, whereas conventional bonds are debt instruments that generate returns through interest payments. Despite these differences, both instruments remain important in supporting economic growth, financing development projects, and providing diversified investment opportunities. Based on our findings, we propose 4 recommendations. Firstly, investors should choose investment instruments based on their financial goals and risk tolerance. Secondly, regulators should continue strengthening transparency and investor protection to maintain market confidence. Thirdly, governments should encourage the development of green sukuk, SRI sukuk, and ESG-related bonds to support sustainable economic growth. Finally, improving financial literacy and investor awareness will help investors make better investment decisions and encourage greater participation in the capital market. That's all from our crew. Thank you.